Now, as we pivot to Europe, obviously we've talked about how rates went up. We talked about that last week. We just wanted to include that once again, just because you can see there is that continuous movement up of a quarter point, which is very much in line with our expectations. But then when you look at confidence continues to slip. On the industrial side, slipping further, which is a problem because it's already down there. GDP slightly better than expected, but Q3 is where we see the biggest impacts, and Europe is more exposed than the US to energy prices. And there's where we're seeing another increase in terms of some of those pain points. So that's why even though CPI estimates were at 5.3%, CPI core actually reaccelerated in July from 5.4% to 5.5%. And that's some of the pain points that we continue to see as manufacturing PMI was expected at 42.7, came in at 42.7. Huge miss on the Eurozone, on the manufacturing front. Well, I shouldn't say huge miss because it was right in line with estimates, but that is a contractionary number. Unemployment rate's fairly stable, but the services is where we saw the shock, and that's what we were expecting. Eurozone services was expected at 51.1, came in at 50.9. We said it was going to be expansionary, but we said that the deceleration is picking up steam, and that's where you're getting that bigger move down, which is why the composite was expected at 48.9, came in at 48.6. So you're getting that additional movement down, which is why we see this area already in a recession, and that's something that we think is only going to get worse. PPI came in a bit better than estimates at negative 0.4. But you're getting another ramp down, another ramp up after some of this reduction, because this is looking at June. Diesel, gasoline, all of these pieces started to go back up, which again is going to offset some of the down. And now we're not saying it's going to explode higher like it did, but you're going to get some of that pressure back in, and either likely come in at 0.1, 0.2, but you're going to see some of that pressure get priced back into the market in July and so far in August. So breaking into its pieces, Germany consumer confidence was expected at 24.8, came in at 24.4, a negative, all of that, but again, still continue. GDP came in at flat. When you look at all the different levels, it was slightly negative, and that's something that we think is going to continue as CPI remained in the positive territory. So again, stagflation, slowing economy. Now, I think, in my opinion, because this is Q2, firmly in a recession while inflation continues to trend higher. When you look at the levels, 6.5%. Price indexes on the import price is actually coming down. That's a good thing. But then when you look at retail sales were expected at negative 0.3, came in at negative 0.8. That is where we continue to see the problems in the retail side. The consumer is going to slow down. Now, we don't think it gaps from negative 0.8 to negative 2%. It's just going to bounce around between that negative 1.2, negative 0.3, and kind of live within this band. The German manufacturing PMI expected at 38.8, came in at 38.8. That's an abysmal number. Exports were expected at 0.3, came in at 0.1. Imports, though, and remember what imports mean for the country is it's a leading indicator for not only domestic, but also not only domestic demand, but also future demand, future exports. So imports were expected to be down negative 0.3. They were down negative 3.4%, which is a big miss, and again points to more pressure on the export side, which will put more pressure on the manufacturing side. Services were expected at 52, came in at 52.3. That's what we see reversing lower again. But net, because Germany is a manufacturing heavy society, expectation for composite was 48.3, came in at 48.5. So then when we turn to France, consumer spending was slightly better than the previous month, but year on year, it's still negative. That's something we don't see changing. GDP was slightly better, but again, that was Q2, and we've actually seen things move further into the negative territory on the service side, which is why we think Q3 is going to be a bit sloppier, especially with CPI and inflation remaining elevated. Manufacturing was expected, PMI was expected at 44.5, came in at 44.5, came in at 45.1. Slightly better as we were expecting, but services was a bit worse, expected at 47.4, came in at 47.1, and that's why the composite came in still deeply negative in contractionary at 46.6. So again, you're still getting that pressure, and a lot of that is on the back of services. When we look at Italy, Italy is seeing that broader slowdown. When you look at the different levels of consumer confidence, manufacturing, sentiment in general, GDP was expected to be at 0.9 year on year. It came in at 0.6. And it's because quarter over quarter, it was expected to be flat, came in at negative 0.3. So again, another nation coming in negative within the Eurozone in general, which is why we see more pressure. Manufacturing PMI came in right around estimates at 44.5, still steeply negative, slightly better than June, but then, or I should say contraction, but the services was expected at 52.2, came in at 51.5. Again, an additional slowdown. Month-on-month retail sales came in negative, and that's something that we see a continuation of, which is why the composite was expected at 49.5, came in at 48.9. And we do see more sluggishness as the service consumer gets a bit worse. Then you look at Spain, retail sales slightly better than expected. CPI, though, pivoted back up, expected to be at negative 0.5, came in at positive 0.1. And again, you're getting some of that reacceleration of core from 5.7% to 6.2. So again, that is going to be a pressure point in general. Manufacturing PMI was expected at 48.3, came in at 47.8, a deceleration, which we think kind of balances out. But remember, services, we've been saying it's going to slow, is expected at 53.4, came in at 52.8, and then the composite, coming in below estimates at 51.7. And we see that accelerating because, again, manufacturing is going to flatline around here, but the services is going to continue to pull that number down, which is why when we start looking at the key areas, German PMI orders, inventories, Austria, Italy, Spain, you're getting that negative pull down. All of that is pointing to additional slowdowns, as we've been saying, with manufacturing PMIs in Germany and Austria are equally weak, and that additional energy shock is not going to help. Euro area change in demand for loans is now fully negative in Q1, Q2. Takes time for that to catch up. But again, that's when you're looking to slow down in the velocity of money, slow down in activity, and that will catch up with itself. Manufacturing PMI in Poland and Germany, again, pulling all of that down as less activity continues. Europe has not followed the US in cutting China imports, which just means that they are very exposed still to the slowdown in China. China is the EU's biggest supplier for several critical raw materials. We are not that just means that we aren't the only ones. Everybody's exposed, but you get an idea where Europe is in a precarious position because we also don't rely on them for an export basis where Europe does. Europe exports a lot of their product to China. And if they start to say, look, if you do this, then therefore we're not gonna buy your stuff, that doesn't have the same impact to the U.S. as it does to Europe, which is going to limit some, or how let's quote unquote tough they can talk on China. EU services sentiment and manufacturing, as we were saying, pivoting down as financial conditions had tight or still remain tight, but you can see weakened a touch. And again, it's going to ebb and flow, but you're getting an idea on why we still think things are going to remain tight in that area. Eurozone service confidence, again, trending down, manufacturing steeply negative, but service had a little bit of a bounce. But again, this is where we think it's a bit wrong on the survey because we do see July getting worse given some of the pressure points we've highlighted. Especially with Eurozone lending has dried up. Non-financial corporations, households, but governments are still there. So, and it's because they're trying to do what they can, but the money supply and the velocity of money is slowing, which just, as we've been saying, is going to pull that GDP down and continue to keep things tight. And you might say, well, they'll reverse. It's like, but they really can't because yes, Eurozone CPI is coming down, but core CPI is actually reaccelerating a bit. That is a huge problem. And if you think about what the EU has done, how they've been so lenient on things, they're going to have to tighten that up considerably. Then when you look at Italy GDP, again, turning negative as the Eurozone composite, all of this starts to show, as we've been saying on a quarter-over-quarter basis, how things will be negative in the country, in the region. And this just puts into perspective on how France is going to be a bigger pull of that because they are the second largest economy there. And you're seeing that deceleration accelerate, which is going to, again, I don't want to say guarantee, but again, push things closer towards where we see things going at this point in time. So that's what we have for you on the Europe side. The next segment, we're going to go deeper into Asia and some of the components, really honing in on China as well.